Hello everyone, ourselves Rishnika.
And THENRAL from Agricultural College and Research Institute curriculum.
This is just a brief introduction about speculation and hedging and forward and future trading, an overview of future trading.
Now let's see about what is speculation. Speculation involves is trying to make a profit from a security price change. It is basically buying and selling of assets with expectations of making a profit from the change in the price. It is essential to allocation of economic resources over a time. The main aim of speculation is to make a profit. It is common among the traders. Speculators are vulnerable to both downside and upside of the market. Therefore, speculation can be extremely risky. It is a sort of gambling, but in the long term, it helps to improve the markets. Speculators help to bring the clarity in the price of underlying asset. We've seen that speculation is extremely risky, but hedging is attempt to reduce the amount of risk or volatility it is associated with the security price change. Individuals will hold inventories of assets only in the expectation increases in the value of those assets by at least enough to cover the cost of carrying the assets. Hedging can be referred to as a kind of insurance. Hedging not just preferred by the traders but also a business too. Airlines use hedging to protect themselves from the volatility in oil prices. The trucking and shipping sectors are also use hedging for oil prices. Hedging versus portfolio diversification. These two are different. First, what is portfolio diversification? Diversification is a portfolio management strategy that investors use to smooth out the specific risks in one investment. Hedging. Hedging helps to decrease one losses by taking an offsetting position.
Good day everyone. You have had the gist about the what is hedging and what is speculation. Let's see the difference between the hedging and speculation. First, we will see some of the common differences. In case of speculation, purchases and sales in the cash as well as in future markets are made with the objectives of making profits. But in hedging, the purchases and sales in the cash and future markets are made to protect oneself against some excessive price fluctuations. In case of speculation, the activities of buying and selling are not necessarily opposed to each other. The activities of buying and sellers are always opposed to each other in hedging. It is not necessary that the two types of transactions should be of equal quantity in speculation, but in hedging, it is obligatory to buy and sell the goods in equal quantities in the two markets. In speculation, the speculators purchases goods and sell them when prices rise as per his expectation. But in case of hedging, the commodities are not stored by the traders, only the difference in the price is given or taken on the due date. Let's see some difference in this slide. First basis is meaning. In case of hedging, they are saying it is the strategy to protect the investment from future any other adverse price fluctuations. In case of speculation, it is only to make profit by trading in the risky assets. In case of objective, hedging mainly focus on reducing risk. In speculation, it mainly focus on profit only. In case of function, it protect the future movement in prices. In case of speculation, it is only in the function of price movement to make profit. Operators. Risk adverse investor optimum and go for hedging. Investor who love to take risk opt for speculation. Volatility. Hedgers protect themselves from price volatility. Speculators use volatility to make profit. In case of profit potential, no or very minimum profit potential. In case of speculation, immense profit or also cause loss profit. Other than this, there are some more also like involves. Hedging involves protection from future movement in price. The speculation involves using price movement to make a profit. In case of risk management, of course, we all know hedgers are hedging to manage their risk. Speculators, on the other hand, use other techniques to manage risk such as stop loss and limit orders, etc. Let's move on to next slide. Let's see the example of hedging and speculation. Assume that a Chicago wheat merchant purchases 10 lakh bushels of number 2 soft red winter wheat in July at the US dollar of 1.45 a bushel for his inventory. He is now exposed to the risk of changes in the value of his inventory due to the fluctuation in the price of his wheat. He is speculating on the price of wheat because here he doesn't care about the future prices, he immediately gone for selling. In case if he prefers, he may sell future contract on the Chicago Board of Trade promising delivery of 10,000 bushels of number 2 soft red winter wheat anytime in December at price currently quoted for December future says a US dollar of 1.52. If he does this, then he is clearly hedging because if he buying that wheat in the month of July, but he is saying he will give that or he will give return back in at the time of December, then he is clearly hedging. Apart from this, there is one more example is also present. Let's see that. Another example of hedging is availing of car insurance to safeguard your car against damages arising due to an. Let's see the second part of the topic. Future trading. Future trading is a device for protection against the price fluctuation which normally arise in the course of the marketing of commodities. Stockists, processors, or manufacturer utilize the future contract to transfer the price risk faced by them. Future trading includes both the hedging and speculation, even though hedging is the raison d'etre. It is also known as hedge trading. Future market are therefore known as hedge market. Widely divergent views exist. Markets are therefore on the effect of future trading. Future trading in various groups of commodities was established about the end of 19th century. In cotton, future trading was started in Bombay. The future market was established for oilseeds at Mumbai in 1900, for wheat at Harapur in 1913, for raw jute and jute goods at Kolkata in 1912, and for bullion at Mumbai in 1920. To provide against unhealthy speculation, forward trading in agricultural commodities was regulated under the Forward Contract Act 1952. The act was enacted with a view to regulating forward contracts, prohibiting option in goods, and dealing with certain other related matters. The Forward Market Review Committee set up by the Government of India under the chairmanship of Professor M.L. Dantwala recognized the need for future trading. Let's see commodities for future trading. The commodities permissible under future trading must satisfy the following conditions. Commodities should be in a plentiful supply. If a commodity in short supply, a few traders may corner the whole supply and charge any price they like to the buyers. The commodity must have minimum degree of perishability, that is, must be storable for future delivery. The commodity should be homogeneous and capable of being graded so that its future deliveries may be made without problem regarding quality. The commodity should have a large demand from a number of independent consumers so that a single buyer may not be in a position to impose his terms for his purchase. The supply of commodity should not be controlled by the few large firms. It should be available with a large number of suppliers. The price of the commodity should be liable to fluctuation over a wide range, and there should be free flow of commodity to and from the market without any outside interventions and controls. Services rendered by the forward market. The forward market renders the following services to the economic system. It enables the merchants, stockists, and processors to protect themselves against the risk of adverse fluctuation in the prices of the commodity. It reduces price fluctuation so that the margin of the profit may be small. The second one is highly competitive character of the market smoothens out price fluctuations and ensures an even flow of goods from the purchaser to the consumer. Avoid gluts in the peak season and shortages in the slack season. And the third one is it brings about an integration of the price structure of commodities at different point of time in the same way as the transportation and communication brings about an integration of prices in different parts of the market. And the fourth one is it facilitates large purchases and sales of the commodity at short notice in advance of delivery and in the absence of production. And the last one is it brings about a coordination of the current and future expectation by a continual realization of stock of goods in the light of chaining supply and demand condition. What are the dangers of forward market? The danger arising out of the forward markets are the forward market open out the way for a large number of persons with insufficient means, inadequate experience and information to enter into commodities which may be beyond their means. In such a condition, market get demoralized. It enables unscrupulous spectators with little interest in the actual supply and demand for a particular commodity to corner the supply and organize bear rates and bull rates on the market in the hope of making easy money for themselves. This results in violent fluctuation in prices. Let's see the difference between the forward and future contract. In case of meaning, forward contract is an agreement between two parties to buy and sell the underlying assets at a specified date and agreed rate in future. In case of future contract, a contract in which the parties agree to exchange the assets for cash at a fixed price and at the future specified date is known as future contract. What it is? Forward contract is a tailor-made contract. In case of a future contract, it is a standardized contract. In trade on over the counter, that is, there is no secondary market in forward contract, but in case of future contract, it is an organized stock exchange. In case of settlement, forward contract on high maturity date and future contract can get on daily basis. In case of risk, forward contract has a high risk, but in future it is low. Default. As they are private agreement, the chance of default are highly in forward contract, but in future contract, no such probability. In size of contract, forward contract depends on the contract term, but in future contract, it is on fixed size of contract. In collateral, forward contract does not require any collateral, but in future contract, initial margin is required. In case of maturity, forward contract, as per the terms of contract, it moves. In future contract, predetermined date is there. In regulation, forward contract is self-regulated and in future contract by stock exchange. In case of liquidity, forward contract has low liquidity and future contract has high liquidity. Therefore, forward contract is the private contract between two parties and the future contract it is traded on public exchanges. At last, speculation is only a word covering the making of money out of the manipulation of prices and instead of supplying goods and services by Henry Ford. Thank you for active listening.